Wait. This changes everything. A company smaller than a New York apartment just locked deals with NVIDIA and Palantir. Why are trillion-dollar giants betting on someone you've never heard of? Here is what most people miss about the stock market. The companies everyone talks about, the trillion-dollar giants, they do not build everything themselves. They cannot. It is physically impossible. Every massive tech company relies on smaller vendors, specialized firms, and niche providers that fly completely under the radar. And this creates one of the most consistent wealth building patterns in market history. Think about it. When Apple needed a supplier for its revolutionary chips, Taiwan Semiconductor was a fraction of its current size. When Amazon needed cloud infrastructure expertise, the companies that helped build AWS were not household names. The pattern repeats across every industry, every decade, every market cycle. But here is the thing nobody tells you. Finding these companies before they explode requires understanding exactly why big players choose small partners in the first place. And that reason has nothing to do with price. The real reason trillion-dollar companies partner with tiny firms comes down to 3 words. Specialized domain expertise. See, when you are NVIDIA, and you need a specific software solution for optimizing data center operations, you have 2 choices. Build it yourself with a team that might take 2 years to develop the expertise. Or partner with a company that has spent a decade doing nothing but solving that exact problem. The math is brutally simple. And this is where it gets interesting. These partnerships are not charity. They are strategic survival. Big companies cannot afford to be mediocre at anything. So they outsource their weaknesses to specialists while doubling down on their core strengths. If this is already clicking for you, drop a like because we are just getting started. But here is where most investors make their first critical mistake. They see the partnership announcement and assume the small company is automatically a good investment. That assumption has destroyed more portfolios than any market crash. But here is what they do not tell you. Having a famous client means absolutely nothing without understanding the contract structure. Let me put this in perspective. Imagine a company announces they have landed NVIDIA as a client. The stock jumps 20% overnight. Retail investors pile and celebrate. But nobody reads the fine print. That contract might be worth $50,000 annually. A rounding error for NVIDIA, but a headline for the small company. Or worse, it might be a pilot program that can be canceled with 30 days notice. The data shows something surprising. Over 60% of partnerships announced between large and small companies either do not renew, or significantly reduce in scope within the first 2 years. That is not pessimism. That is documented reality from analyzing thousands of corporate filings. So what separates the partnerships that create generational wealth from the ones that destroy it? 3 specific metrics that Wall Street analysts use, but rarely share publicly. The first metric is revenue concentration ratio. What percentage of the small company's total revenue comes from their largest client? If NVIDIA represents 40% or more of their business, you are not investing in a company. You are betting on a single relationship. And this is where it gets truly revealing. The second metric is contract duration and renewal history. Annual contracts signal testing. Multi-year agreements signal commitment. But here is the real tell. Look at the expansion pattern. Did the contract value grow between years? A 20% annual increase means the large company is deepening trust. Flat renewals mean they are maintaining minimal viable engagement. The third metric is the one most investors completely ignore. Integration depth. Is the small company's product or service embedded into critical operations? Or is it a nice-to-have peripheral tool? When a product becomes infrastructure, switching costs make the partnership nearly permanent. Think about that for a second. 3 metrics. revenue concentration, contract expansion patterns, and integration depth. This is how institutions separate signal from noise. But the real opportunity is this. Everything I just told you was the framework. Now let me show you why this specific setup with NVIDIA and Palantir clients is catching institutional attention right now. Here is what happened. A small cap company, market cap under 500 million, quietly announced expanded partnerships with both tech giants within the same quarter. Not pilot programs. Multi-year enterprise agreements. The contract value grew 43% from the previous period. And here is the kicker. Their product is not something NVIDIA or Palantir could easily replicate. It solves a problem both companies face with their enterprise customers. Data orchestration across hybrid environments. If you want to see how this actually plays out, make sure you are subscribed because this is where the analysis gets specific. When you apply those three metrics we just covered, the picture becomes remarkably clear. Revenue concentration sits at 18% for their largest client. Healthy. Contract expansion is demonstrable and documented in SEC filings. Integration depth shows their solution running in production environments, not sandbox testing. The math does not lie. But here is where most people get it wrong. They see these metrics and think the hard work is done. But wait. There is a better way to think about this. Strong fundamentals do not guarantee stock price appreciation. They create the conditions for it. The difference is crucial. A company can have perfect partnership metrics and still see its stock decline for years if the broader market ignores small caps, or if their sector falls out of favor. This is the hidden risk most retail investors completely overlook. Timing matters. Not market timing in the gambling sense, but understanding where we are in the small cap cycle relative to large cap dominance. For the past several years, mega cap tech has dominated returns. Money has flowed away from small companies regardless of their fundamentals. And this is where it gets truly interesting for anyone paying attention. That cycle shows signs of reversing. Small cap valuations relative to large caps have reached levels not seen since 2000. Historically, these extremes have preceded significant small cap outperformance periods. So what does all this mean for you specifically? What the wealthy do instead of chasing headlines is build systematic frameworks for evaluation. They do not get excited about partnership announcements. They get curious. They ask the three metric questions before committing a single dollar. Revenue concentration. Contract expansion patterns. Integration depth. And they layer in cycle awareness. Understanding that even perfect companies can underperform in unfavorable environments. The specific setup we discussed today, the small cap with NVIDIA and Palantir contracts, represents exactly the type of situation worth monitoring. Not buying blindly. Monitoring. There is a profound difference. Smart investors create watch lists based on frameworks, and wait for two things to align: strong fundamental metrics and favorable market conditions. When both align, position sizes can increase. When only one aligns, positions stay small or non-existent. This is the actual difference between wealth building and wealth destruction. The patience to wait for alignment rather than forcing opportunities that look good on the surface. Here is your action plan starting today. First, create a simple spreadsheet with 3 columns: revenue concentration, contract trajectory, and integration depth. Every time you see a partnership announcement that excites you, fill in those columns before doing anything else. Second, track the small cap versus large cap valuation ratio. When it reaches extreme levels like now, prepare your watch list. You want opportunities identified before the rotation begins, not after. Third, and this is critical, define your position sizing rules in advance. How much will you allocate to a small cap that meets all criteria? How much if it only meets 2 of 3? Write it down. Remove emotion from execution. The setup we discussed today will either work out, or it will not. That is not the point. The point is you now have a framework that works regardless of any single opportunity. You can evaluate thousands of situations with the same systematic approach. That is how fortunes are built. Not through hot tips. Through repeatable processes that compound over decades. Now you understand why smart money pays attention to tiny companies with massive clients. It is never about the announcement. It is about the metrics behind it. Subscribe to decode more financial truths the mainstream ignores. And tell me in the comments, what is the smallest company you are currently watching, and why? I read every single response. Next time, we are breaking down another setup Wall Street hopes retail never discovers.